But first, our talk of the tape. Will this week's crucial catalyst tilt the advantage toward bulls or the bears, with the S&P 500 stuck in a sideways range since mid-July? Here to help sort it all out, our CNBC contributor Bryn Talkington of Requisite Capital, J.P. Morgan's Jordan Jackson, and Citi's Scott Chronert. Welcome to you all. Bryn, you would have thought perhaps that on Monday of this week, with a lot at stake in terms of these announcements coming, maybe the market would just sort of idle and not do much. We're making a little bit of upside progress. What's your read on the action and whether, in fact, implicitly the market is in the soft landing camp?
The market right now is definitely, it has been in that soft landing camp. I think that at the beginning of the year, consensus that we were going to go into a recession, and as that has obviously come off as a probability this year, then we've had a huge re-rating. And so I think that unless we see the 10-year firmly go above 4.25, the 2-year go firmly above 5, as we still bounce around those levels, I think the market remains in the soft camp landing. But I do think that as we get further into the end of the year, next year, there's still so many cross currents between the consumer, balance sheet running low, consumer credit defaults kicking up, while at the same time, Mike, the Atlanta Fed is saying we're going to have a close to a 6% GDP print at the end of the year. So lots of cross currents for us to debate. But right now, the market is definitely in that soft landing camp. But I do think September and October, as is relevant or as is typical for history, will still be bumpy.
Yeah, well, it's working out that way, although the bumps haven't been all that uncomfortable, at least not yet. And Jordan, Bryn mentions a bunch of these headwinds that do sit out there. You have potential disruptive UAW strike. We talk about a government shutdown. We talk about student loan repayment restart. And then, of course, a little bit of stress showing up in pockets of the consumer. At the same time, the economy seemed to have a lot of momentum through July. So maybe all that boils together to be a relatively comfortable growth rate. And of course, we have the Wall Street Journal over the weekend pointing out that the Fed seems like it's very patient and is willing to keep rates here for a while. So how does that all net out to you, Jordan?
Well, I think you've highlighted all the dynamics pretty well. There's a lot of cross currents at play. We could be entering into a period in which the consumer starts to come under pressure, but businesses have already done a good job preparing for this pending recession, and they've shored up their margins, they've shored up their balance sheets, and so as the consumer potentially comes under pressure, you may see business investment beginning to start to pick up. You're now seeing Inflation Reduction Act and CHIPS money beginning to flow through into the private sector, and that's supporting the investment spending. Housing can't really get much worse at this stage, and so you're probably seeing a little bit of a bottoming out and a slight reversal, especially if we get a bit of a reprieve in mortgage rates. And so while the consumer may be coming under a bit of pressure, you could see other parts of the economy doing okay. And that allows growth to kind of slide down to maybe a sub-trend pace over the first half of 2024, but we don't dip into a recession. And I think that's what all risk assets, most risk assets, are hoping for, pointing towards when you look at equity valuations, when you look at credit spreads as well. And so, again, markets are trying to balance the risk and thread the needle between a soft recession and a soft landing.
Yeah, that is generally reassuring. And Scott, I guess the question would be that if you agree that markets largely are now positioned for that type of relatively benign outcome, how does the risk reward look? In other words, is the direction of surprise to something nastier or something more positive?
Well, I think to the earlier point, we've been pricing in soft landing since the first part of June. And so the more you run that cyclical component of the market, the more you set up for a change in sentiment around this. So I think we have to consider this like through a more balanced lens. We're still approaching the high end or the peaking of the Fed rate cycle. We think earnings are going to continue to show through pretty resilient. But to the earlier point, I do think there's going to be some dispersion in terms of how economic impacts are felt through the market. So I think all told, I think the balance is still to the upside into the end of the year. And we're going to kind of fall back on our ongoing view that the fundamental underpinnings for the S&P remain pretty positive at this point.